Welcome to the latest episode of The Financial Frontier. I'm your host, Patrick Camuso. Today, I want to do a solo episode so we can get into some of the details about the 1099 DA and what I'm calling the beginning of the compliance era for digital assets. So if you've been tuning into The Financial Frontier over the past few weeks and months, you've seen a series of guests that have come on to discuss the 1099 DA from different perspectives. We've had people on from former positions in the IRS, tax lawyers, tax professionals, software providers that are facilitating the issuance of some of these forms. Really, people from all the different perspectives that are involved in this new compliance requirement and or people that are advising on it are going to be impacted by it. And I encourage you to watch all those episodes. We even have a few more that are going to be airing before the end of the year. But today I want to kind of, chime in and give my perspective a bit. Now, I've covered a lot of information on the 1099 even outside of the financial frontier on my firm's website, camusocpa.com. I encourage you to check that out as well if you really want to see deep dives on some of these topics. And that's where you can find the blogs. And on my YouTube channel, just by typing in Patrick Camuso, you can find many videos on this topic as well. But 2026 is going to be a big year for digital asset compliance. Like I said, this the digital asset compliance era. And this is, based on my observations and really what I'm seeing form here for 2026 and taking into account, everything I've seen in this market over the past decade related to compliance and taxes and accounting and all the different market participants. So, it's no secret that digital assets are largely, unregulated since their inception, since over the past decade. That's why the name of this podcast is The Financial Frontier. Digital assets have been, disconnected largely from the oversight models that shape traditional markets. And the 1099 DA, I think, is a great example of that. Obviously, for securities and, more traditional investments, you have the 1099B and other tax reporting regimes. And what we're seeing now is that crypto is still the frontier. It's where innovation is going to happen for, from a financial perspective and just in general. But it's no longer going to be ungoverned or unregulated. We're entering this new phase, a regulated phase to a large degree, for companies and even investors to move ahead in this market. The legitimacy of your company or your investment portfolio is going to be tied to your compliance. And this is something that's going to impact every CFO, PA, investor, intermediary, everyone that's operating out there now. And the 1099 DA is just the start of it. So, what have we seen this past year? And again, a lot of these things I've covered on the financial frontier. We've seen the start of enforcement actions that are related to purely crypto tax cases with Algren III, Waylon Wilcox, Roger Ver. Those are the three most notable over the past year and a half. And what this is showing is that, the IRS can do enforcement with digital assets. There's been this narrative, especially in the early days, the IRS doesn't understand crypto or they don't care about it. And I think these cases serve as a great example that that's not the case. These transactions have always been taking place on a public immutable ledger. And you're starting to see what some of these headline cases, what the results of these audits can be. In addition to that, we've seen a lot of tax notices go out this year. And this is before the 1099 DA. I'm seeing it firsthand at Camuso CPA, not really here now in December, but, I'm talking just over this year, where there were waves of tax notices that went out to people that were not reporting, where more or less the IRS tells them they do believe that they have digital assets and that they should look into reporting if they are underreporting. So we're seeing this enforcement this year that now the IRS is just going to get more visibility into the amount of the overall transactions that are happening with the 1099 DA. And they're still citing a 75% non-compliance rate. We'll see how the 1099 DA impacts that. And, we're starting to see signs also of legislative, to a certain degree, where there's more focus on the taxation of digital assets. Just a few months back, we saw the Senate Finance Committee hearings, and, we've seen many different bills and, a build up in focus legislatively on crypto taxes. And, the momentum is shifting from taxpayers possibly just, interpreting things based off of notices and FAQs and selective regulations to more comprehensive legislation around crypto taxation here in the future. And, that's something that I'm watching closely and will be reporting on closely here on the Financial Frontier. But this is, another trend in the direction of the fact that we're entering this compliance era. Adding on to that, we have the accounting standards starting to focus, the accounting standards bodies starting to focus increasingly on digital assets recently with, FASB adding stable coins and, other digital asset accounting considerations to their agenda. It's another signaling of this structural turning point to where digital assets are entering a phase where they are financially respected or material to the balance sheets of companies. And institutional investors can't participate in these markets without uniform recognition, measurement, and disclosure rules, which is why, we're starting to see this focus. So, this is, again, another step towards the compliance era. And then, what we're going to hit on a bit more here is obviously we have the CAR framework that's going to be coming out, which is going to impact information exchange internationally regarding the transaction records for digital assets for taxpayers. And here in the States, we have the 1099 DA, which is a structural turning point in terms of the data collection and the activity that the IRS is going to get regarding the taxpayers. For the first time in the history of U.S. taxes, digital asset workers are going to transmit standardized activity to the IRS on the transactions that are happening on their platform. So, for these reasons, and there's more, I don't want to make the whole podcast on just this topic. Obviously, we're going to be now moving into the, tokenization, real world assets, which is going to require even more serious clarification around, regulations, tax treatment, accounting standards. And, that's pushing us more into the compliance era. So I've done whole videos on this. I've done whole blogs on this. So again, I encourage you to check out YouTube and the blog. Overall, we're entering the compliance era, and the 1099 DA is one of the first demarcation lines that are going to be in the mailboxes of taxpayers in really no time at this point. So, it's going to be an interesting tax year with the 1099 DA because there are many challenges that are going to result from taxpayers getting this the first year. Firstly, what I'm anticipating is one of the biggest questions is that taxpayers are going to have is that they're going to get these 1099 DAs and it's not going to have cost basis information for this tax year. And right away, I think that's going to cause not tax reporting issues, but it's going to cause the taxpayer to at the very least recognize that they're going to have to do a self-reconciliation for accurate tax reporting. Now, to a large degree, the taxpayers may not do this or do it properly. And then, they're going to have a bigger issue on their hands. So, they're going to be getting these 1099 DAs in the mail. It's not going to have cost basis information. And firstly, it's going to expose them to potential matching issues with the IRS when they go to file their returns. If they don't report the 1099 DA correctly, or if they do report the 1099 DA, but it's not reported correctly and properly reconciled with their own accounting, they're going to have matching issues or potential overstatement in their taxes. So, that's going to be a huge issue right off the bat with the 1099 DAs. The 1099 DAs are also not going to capture all of the taxpayers' reportable activities potentially. Now, obviously, this varies taxpayer to taxpayer. Not every taxable transaction that's taking place for every taxpayer is going to be in the 1099 DAs. There's many types of transactions that are not included in the 1099 DAs this year. Transactions that are happening in non-custodial wallets are also not going to be included. So this is something else that's going to require a deep reconciliation with the taxpayers' accounting records versus the 1099 DA and a proper reporting of both. Now, going back to the 75 non-compliance rate, this is something that we still see persistent in my own experiences at Camuso CPA, where we have investors that come to us and, they haven't done their crypto accounting sometimes for 5 to 10 years. In extreme cases, we're still going back into the 2013 to 2014 era. And the reason why we have to go back is to reconstruct the cost basis. If you've been accumulating Bitcoin or Ethereum or any of these assets for years and accumulating them and possibly exchanging them and disposing of portions of them, those cost basis calculations for each year build upon each other. So if you've never done these calculations, you're not going to have this information. And many taxpayers are in this position. Like I said, I see this firsthand. So this is going to be, another big issue, I believe, for many taxpayers that get to 1099 DAs. They're going to now realize that they are going to have to report this form, and they may not even have proper accounting records to reconcile this form against. And they may have a very long road to even being able to accurately report all of this information. So, these are going to be some of the challenges. Another potential issue may be taxpayers that get the 1099 DA and think, if it's not on the 1099 DA, they don't have to report it. So, obviously that's not the case. Like I said, there's going to be a lot of transactions on the 1099 DA that are not on the 1099 DA, but that are reportable for taxpayers. Now going back to the cost basis reconstruction of it, another issue is that many taxpayers still are not in compliance with Revenue Procedure 2024-28. They may be doing their accounting on a universal basis. They may be planning or expecting to report under an accounting methodology that they will not be able to report under for the tax year that they're reporting in, since it's already taken place. So thanks with the revenue procedure and misunderstanding of accounting method requirements and wallet segregation and standing orders and these types of considerations that go into the accounting method is going to be another issue for taxpayers. They're going to have to get their accounting done, but it's going to have to be done right. And a large factor goes into making sure that they select the right accounting methodology and apply it correctly on an account by account and a wallet by wallet level. Now, with the revenue procedure, this is something else that I've covered and even discussed with many guests here on the Financial Frontier. There is even a debate and varying treatments across practitioners when it comes to the applicability of this revenue procedure to non-custodial wallets and really, what the true definition of a wallet is. And it gets very technical. So again, I've covered this in separate articles. I'm not going to get into it into deep detail. But, these are going to be the types of issues that start to come up for taxpayers once they receive this form, realize that they need to be reconciling this form with their own accounting. Then all of these issues are going to start to surface. Another issue or, something that taxpayers should be watching out for with this form is that for the most part, it's going to be on a standardized time convention, likely UTC time. That's not going to be on the taxpayer's local time zone. So especially if there's transactions at the end of the year, there may be a timing difference in what the taxpayer reports and what the DA reports. The same thing can go if there's large price swings and the timing factors in for that as well, depending on when these transactions happen. With the taxpayers reporting, it needs to be done on the local time zone, and that's going to need to be reconciled with the 1099 DA that is not within that time zone. So there can be some differences there that need to be adjusted as well. So, what this 1099 DA is doing for the IRS this year, it's going to give them visibility into, what taxpayers have done this year on exchanges and other platforms, it's not going to really be doing calculations for taxpayers. But this is going to be enough to where if there's reporting mismatches, it can start creating compliance issues for taxpayers, and they may be, begin to start receiving underreporting notices if there are mismatches between what they're reporting, what 1099-D8 is reporting. And that is a big concern, but this can extend even past the IRS at the state level as well. The 1098 is a federal informational return, but its impact isn't limited to the IRS. The states are expected to utilize this data as well, directly or indirectly, and they're going to use it for their own audit purposes and their own matching purposes to match the crypto proceeds to the state returns and identify missing filers or overall non-compliance and matching issues. So that's something where we're just starting to see a few states release state tax guidance. That's something else that I'm watching here closely, but this is going to impact people both at the federal and state level. So compliance is crucial for both, and getting the tax reporting accurate is crucial for both. So this is something that I've been heavily focused on, and I believe is going to have a huge impact on the industry and on taxpayers as we enter into this new year. So, what should taxpayers be doing? They should be making sure that they've reconstructed their basis, that they've aligned with the revenue procedure 2024-28, and that, they're fully positioned, that everything's up to date, their accounting's up to date, they're fully in compliance. When they receive these forms, then they can take the further steps of doing a proper reconciliation before they take the step of reporting. But it really first comes down to, having a deep understanding of these forms and what they are reporting and what they're not reporting, and having a full and accurate accounting and reconciliation done when it comes to your digital asset activity within your portfolio or business. Again, these 1099-DAs are not going to be a completed tax calculation. And, there's going to have to be a lot of work done on the taxpayer side to make sure that you're maintaining compliance, you're avoiding any tax notices or issues, but that you're also accurately recording your activity. So, I wanted to really just give my perspective. Again, I think 2026 is the start of the compliance era for digital assets, and the 1099-DA is going to be a big demarcation line as we enter into this stage. And if you want to get more information on the 1099-DA or anything related to this that we discussed, firstly, I've done some really great episodes on this with Jesselyn Dean, Miles Fuller, Raj Mukherjee, several other people as well that I'm leaving out. So, I would encourage you all to, check out those previous podcast episodes. Go to camusocpa.com, check out some of the articles that I've written on this topic, and check out my YouTube channel as well, where all the previous podcast episodes are posted there, as well as deep dive videos where we go over many of these topics, including the compliance era, the different discussions around the 1099-DA, the revenue procedure, and other topics. So, all that information is there. In terms of what to expect for 2026 from the financial frontier, it's going to be a very big year. I have a lot planned for the financial frontier to get even deeper into some of the developments as we do enter this compliance era. So, look for a lot more updates from us, a lot more content, and a lot more value that we're going to add to you as viewer and listener. So I'm very excited for this as well. So, I hope you took some value from listening to this episode. I wanted to make this brief and, again, just really give my perspective. And again, I hope you took some value from it. Until next time, I'm Patrick Camusa, signing